In the early 2010s, a new kind of company burst onto the scene, promising to transform the very fabric of our working lives. WeWork, co-founded by Adam and Rebecca Neumann, wasn't just offering office space, they were selling a dream, a community, a lifestyle. The vision was audacious, to create a global network of beautiful, collaborative workspaces that would elevate the world's consciousness. It sounds a bit much, I know, but at the time, this message resonated deeply with a generation of entrepreneurs and freelancers looking for more than just a desk. Before WeWork, co-working was a niche concept, mainly for individual freelancers. But Adam Neumann saw its potential to scale, to appeal to small businesses, and even to enterprise clients. He envisioned WeWorkifying every aspect of life, from apartments to schools. The company expanded at a staggering pace, signing long-term leases on prime real estate and then subdividing and redecorating the spaces to rent out to members on flexible, short-term contracts. It was a simple, yet incredibly capital-intensive, arbitrage model that seemed to work magic, at least initially. Then came SoftBank, a Japanese conglomerate led by the enigmatic Masayoshi Son. Son was famous for his Vision Fund, which poured billions into promising tech startups with the goal of achieving hypergrowth. He met Adam Neumann and, by all accounts, was captivated by his boundless optimism and grand vision. What followed was an unprecedented flood of capital. SoftBank and its Vision Fund invested billions upon billions into WeWork, fueling its rapid global expansion and propelling its valuation to dizzying heights, which, to many, felt almost unbelievable. At its peak, in early 2019, WeWork achieved a private valuation of an astonishing $47 billion. Let that sink in for a moment. This was a company that essentially sublet office space, albeit with a cool design and a strong community vibe, being valued higher than many established real estate giants. It was a testament to the power of narrative, the charisma of Adam Neumann, and the venture capital world's insatiable appetite for disruptors and unicorns. For a while, it seemed like WeWork could do no wrong, consistently defying traditional business logic with its soaring valuations. With billions flowing in, Adam Neumann's lifestyle became increasingly extravagant, blurring the lines between personal and corporate finances. There were private jets, lavish parties, and investments in side ventures, often funded by WeWork itself. This wasn't just about personal wealth, it was about a leadership style that seemed to prioritize expansion and spectacle over profitability and sound governance. Stories emerged of him buying buildings and leasing them back to WeWork, which, as you can imagine, raised a lot of eyebrows and ethical concerns among investors and board members alike. Beyond the extravagance, deeper issues plagued WeWork's corporate governance. Adam held extraordinary control through supervoting shares, giving him power disproportionate to his equity stake. His wife, Rebecca, also held significant influence, sometimes over areas she had little experience in. This lack of independent oversight, coupled with a culture of growth at any cost, meant that financial discipline and accountability often took a backseat. It was a recipe for disaster, essentially putting an unchecked visionary at the helm of a multi-billion-dollar operation, which is a wild thought when you think about it. The moment of truth for WeWork arrived with its initial public offering, or IPO, attempt in mid-2019. To go public, companies must file an S-1 prospectus, a detailed document that lays bare their financials, risks, and corporate structure. When WeWork's S-1 hit, it was a shockwave. It revealed staggering losses, questionable related party transactions, and a governance structure that granted Adam Neumann immense power. Investors and analysts, now scrutinizing the company with a public market lens, suddenly saw a dramatically different picture than the one painted by the enthusiastic founders. The S-1 filing wasn't just about governance, it also exposed the precarious financial health of the company. WeWork was burning through cash at an alarming rate, losing billions year after year without a clear path to profitability. The company tried to position itself as a tech company, but its core business was, and remains, real estate. The short-term rental model, while flexible for clients, meant WeWork bore significant long-term lease liabilities, which became a huge burden as the growth machine slowed. This was a classic case of growth prioritized over all else. The reaction from potential investors was swift and brutal. The public market simply wasn't buying the tech company a narrative for a business with such massive losses and unconventional governance. The proposed valuation for the IPO plummeted from the earlier $47 billion down to figures like $20 billion, then $15 billion, and even lower. The enthusiasm vanished almost overnight. Investment banks pulled back, and the IPO was eventually postponed indefinitely. It was a catastrophic blow to WeWork's reputation and its ability to raise further capital. With the IPO in shambles and the company facing a liquidity crisis, pressure mounted on Adam Neumann. SoftBank, WeWork's largest investor, had too much at stake to let the company completely collapse. Masayoshi-san, who had once championed Neumann, orchestrated his removal as CEO in September 2019. It was a dramatic fall from grace for the charismatic founder. While Neumann left with a substantial severance package, his exit marked the end of an era for WeWork, the end of the growth at all costs mentality that he so embodied. Following Neumann's ousting, SoftBank stepped in with a massive rescue package to keep WeWork afloat. This included a $3 billion tender offer for existing shares and $5 billion in new debt and equity financing. Essentially, SoftBank doubled down on its investment, taking majority control of the company. Their goal was damage control, stabilize the business, cut costs, and steer it towards profitability. It was a difficult, painful process, with widespread layoffs and a complete overhaul of the leadership team, but they really had no other choice. Under new leadership, WeWork embarked on a painful restructuring. The focus shifted dramatically from hypergrowth to profitability and operational efficiency. The company divested non-core assets, negotiated with landlords to cut lease liabilities, and scaled back its global footprint. They began emphasizing their flexible office solutions as a benefit, rather than just a cool place to work, trying to appeal to a more pragmatic customer base. It was a stark contrast to the previous era of move fast and break things, becoming more about careful, calculated survival. Just as WeWork was trying to find its footing, the COVID-19 pandemic hit in early 2020. This was a devastating blow for a company built on the premise of shared office spaces. Lockdowns and the rapid shift to remote work meant that co-working spaces, once bustling, became eerily empty. Demand plummeted, memberships were cancelled, and the entire flexible office market faced an existential crisis. The pandemic accelerated the decline, making the already difficult path to profitability seem almost insurmountable. The timing couldn't have been worse, really. Despite its troubles, WeWork eventually managed to go public in October 2021, not through a traditional IPO, but via a SPAC merger. This allowed it to bypass the rigorous scrutiny of a standard IPO process, but it certainly didn't mean smooth sailing. The valuation was a fraction of its former glory, around $9 billion, far from the $47 billion peak. While the public listing provided some much-needed capital, the underlying business challenges and the impact of the pandemic continued to weigh heavily on the company's performance and stock price. Even after going public and implementing significant cost-cutting measures, WeWork continued to struggle. The company never truly achieved sustained profitability. Its legacy long-term leases remained a substantial liability, especially in a market where hybrid work models became the norm, reducing the need for full-time dedicated office space. New competitors emerged, offering more agile and cost-effective flexible office solutions. WeWork's brand, once synonymous with innovation, became a cautionary tale of overvaluation and unchecked ambition, which is a tough spot to be in. In November 2023, the inevitable finally happened. WeWork filed for Chapter 11 bankruptcy protection in the United States. This move was aimed at renegotiating its burdensome leases and restructuring its debt to try and emerge as a leaner, more sustainable business. It was a stark and humbling conclusion for a company that once promised to redefine work itself. The bankruptcy filing wasn't a sudden collapse but the culmination of years of financial mismanagement, overexpansion, and external shocks like the pandemic. A truly sad end to a once promising dream. So, what exactly went wrong? You could point to Adam Neumann's excessive spending and conflicts of interest. You could blame SoftBank's growth at any cost strategy, pumping billions into an unsustainable business model. The pandemic certainly delivered a fatal blow. But at its core, WeWork's decline was a classic case of a company that lost sight of its fundamental business. It was a real estate company trying to convince everyone, including itself, that it was a tech disruptor, inflating its valuation far beyond its actual worth, and that's a dangerous game to play. The story of WeWork will undoubtedly be taught in business schools for decades as a cautionary tale. It highlights the dangers of unchecked founder power, the perils of venture capital excess, and the importance of sound corporate governance, especially when billions are on the line. While the co-working model itself is still valid and evolving, WeWork's spectacular implosion serves as a stark reminder that even the most inspiring visions need a strong, profitable business foundation to endure. It's a powerful lesson that sometimes, the most innovative ideas require the most disciplined execution.